So, good morning. Good morning. My name is Peter Williams, and then today we're going to do a little bit exposition on the Income Tax Act 2000 Act 896. We want to do a little bit exposition on the income tax in Ghana. So anybody who receives an income or makes money in Ghana, be it whatever form, is supposed to pay taxes at the end of the year. Great. And then when you come to section 1 of the act, it says the income tax is payable for each year of assessment. So it means at the beginning of every year you send a provisional assessment. At the end of the year you are supposed to do a final assessment of your tax, and then you pay. So anybody who an assessment has been raised on him is expected to pay tax. Or and the classes are two: a person who has a chargeable income for the year, and a person who receives a final withholding tax payment with withholding payment during the year. The section 2 talks about chargeable income. Chargeable income of a person is defined as the income of a person for the year of assessment. For us in Ghana, the year of assessment is 1st of January to the 1st of December each year. So the chargeable income of a person for a year of assessment is the total assessable income of that person for the year from each employment, business, or investment, less the total amount of deductions allowed that person under this act. So your chargeable income is the total of your assessable income of that person for the year, arising from employment, arising from business, and arriving from investment, less the total amount of deductions or expenses which is allowed under this act. And it continues to say that the person who determines the chargeable income of that person or another person shall determine the chargeable income for each source separately. So in determining the chargeable income, you do the assessable income for your employment, your assessable income for your investment, your assessable income for your business. You are supposed to prepare it separately. You're not supposed to combine it. Now, what is an assessable income? Assessable income of a person is defined under Section 3 of Act 896. Is the income of that person from any employment, business, or investment. Asa, the income from a person, the income of a person from his business, investment, or employment. Three things, three sources. So the assessable income talks about the source of that income. It continues to say that in the case of a resident person is someone who have stayed in the country for 183 days or more. So in the case of a resident person, the income of that person from each employment, business, or investment for the year of assessment, whether or not the source which the income is derived from has ceased, whether in the course of the year you lost your employment or not, you are supposed to declare that assessable income and see if you can pay some taxes on it. The income of a person from employment, business, or investment has a source in this country, if the income accrues in or is derived from this country. Okay, so the income from employment, section 4. The income of an individual from an employment for a year of assessment is the gains and profits of that individual from employment for the year or parts of the year. So the gains, benefits, interest you derived from employment makes the total of income, assessable income for the year. It's simple as that. So when you are in employment, all the benefits you gain, all the gains you make from that employment, all interest you derive from that employment constitutes your assessable income. That is it. And also from business, the gains, the profits, the losses, the interest, benefits, all those things comes under the assessable income for business. And now for investment, all the gains, benefits, profits, interest you make from investment constitutes your income from investment. So last 2 weeks or 3 weeks ago, there was a lady who had a birthday party, a birthday, and was dashed a vehicle, right? Another two was dashed a house and vehicle. What the law says is that all the gains, you have to declare it. You have to declare the gifts you made, you received out of that. And now, if the source is from your employment, you have to. If the source of that gift is from your employment, then what the law requires is that you add it up to your assessable income from employment, where it is the gains or the benefits or the interest was derived from business. Maybe the one who dashed you the mobile phone on your birthday was a business associate or not, you add it up to your assessable income from investment, from business. Where it is from investment, you had a car and you sold the car, you bought the car for 1,000 Ghana cedis and you sold it for 2,000 Ghana cedis. That gain in that investment constitutes your income from your assessable income from investment. So that is it. So this is the little thing I wanted to espouse as to, and then take note of this. Income from employment, income from investment, income from business are all accessible to the tax. Depending on the source of it, it will be classified as income from employment or income from business or income from investment. Thank you. Continue some other time.